The main focus for these recaps is breakouts and second legs. So we're going to look at the chart as a whole picture and try to view the market and the price movement in terms of breakouts and second legs. The blue lines I have on the chart are the prior day's high and low, which is actually this bull bar. On the daily chart, this blue line here is Friday's high, and the blue line below is Friday's low. And if we look at the price movement going into today, we have a gap up going into the day and a more bullish regime. Bars above the moving average, lots of buying. But there's actually a problem for the bulls. And if you think about it, you always need a trader willing to buy and willing to sell. You need a trader taking both sides of the trade at every tick. And this is why moves that are parabolic are unsustainable, because there is such a thing as too bullish. Like if a price movement becomes so parabolic that just look at the slope of the movement. And it's already steep here, and it just gets steeper. And what happens is you have bulls unwilling to buy. You have bulls that bought anywhere down here, and when the price is this climactic, this far above moving average, this steep, it becomes too strong, and too strong circles back to bearish. What happens again is that bulls who bought lower are going to look to take profits, and they're not going to buy again until the value is right, the price is more fair. And then you have bears who see that we have several pushes, it's climactic, unsustainable, bears are willing to sell far above the average price, betting that we'll go sideways to down. So right on the open, we have a gap up, but the context really not ideal for the bulls, not a sustainable bull trend. More climax, pause, and a third consecutive buy climax. So a bull bar on the open, but followed by an even stronger bear trend bar. And this bear bar led to a series of bear bars, and we ended up getting about a 7-bar bear micro channel on the open. And I know what some people are thinking. We have a rally, and then we finally have the first test of the moving average. So you can buy here, you can buy the high too, second reversal up. And you can, yes, that makes sense. You think about this rally, it's probably going to get a second leg, but this sell-off is stronger than the bulls wanted to see. Pullbacks and bull trends should not be 7-bar bear micro channels. It's too strong. In the channel down, it's a spike, it's too tight. And so there is going to be some support here because of the gaps open. And this leads to a big up, big down situation. So trading range becomes more likely. The bulls will probably get some sort of second leg up, but now the bears are likely to get a second leg down. The logic for that is always trapped traders. It is true, down here there are trapped traders. Even if it's a buy climax, and it might lead to a trading range. So the result is typically a trading range, and after big up, big down, you usually get a contracting triangle, which is basically what we got here, but I'll get to that. But the logic behind this, big up, big down, there are trapped traders from the rally, and we don't know where the buyers are going to come in, but we do know that bears who sold anywhere in here got trapped on the rally. They're trapped into a losing position. They're going to use the first sell-off to buy back shorts and try to avoid a loss. You have bulls who missed the rally looking to buy a pullback to capture a second leg up. So bulls are trapped out of a winning position. So you have bulls and bears both looking to buy, and that creates support. And this might have been maybe it's a 50% pullback of this rally. So around 50%, this is the moving average on the 60-minute chart, the 20-bar EMA. And then there's breakout points as well. Acceleration here on 77, 78, breakout point. That was also tested. But the point is, big up, big down, probably buyers below, but also sellers above. Now, if we zoomed in on a smaller time frame, bar 2, 3, and 4 is a spike in channel, and it continued. We ended up getting a spike, channel, and then another bear breakout. But the expectation is a retest of the bar 3 high, or somewhere up here. Sellers above, and a second leg down. And even though you know there were probably buyers down here, like I said, this sell-off is too strong. So the first trendline break is probably minor. So we do get a trendline break, good for the bulls. Now we're probably going to get a retest of the lows, and then the bulls can go for a major trend reversal. But first, the expectation is a test of the lows, and that might be the bar 9 low, stop orders trapped there. Maybe it's the bar 7 low, bears trying to get one tick below bar 7. But I want to talk about the price action in here. So again, big up, big down, big confusion, expecting a second leg up, also expecting a second leg down. This rally for the bulls, it was two legs, you could say. One, pullback. Two, second leg, testing high in the trading range. But the rally here is strong enough. And if you think about the close of every third bar, the close of every third bar is a close on the 15-minute chart. So we actually have a breakout and follow through. Bar 12 and bar 15. These are 15-minute bar closes. Strong enough rally, second leg up, likely. So first reversal down, probably minor. So the bears want this to be trend resumption down, breakout, pullback, second leg. But this might have been enough buying in this pullback that this sell-off is a pullback of the pullback. And even this subdivided into two legs. 16, pause, 18, two legs down, testing a breakout point. The bar 10 high, probably buyers here for at least a scalp. Now the bulls rally again, but we're still expecting a second leg down because of this bear breakout. The pullback, surprisingly strong. Bulls should get a second leg. Pullback, they're getting their second leg. But before we tested the highs, the high close, we ended up getting 24. And now 24 might be resumption down. One, complex pullback. And this is a low 2 on a high time frame chart. And I keep saying big up, big down. And we end up getting a triangle. It's breakout mode. And because of the bear breakout, there might be a slightly bearish bias to the direction of this triangle, but I think it also helps to know where you are on the higher time frames. Like if we just think about the daily chart, Friday, pretty good looking bull bar for a buy signal bar, but what's the context? We just had 6 or 7 consecutive bear bars, and it's a tight channel, and the odds are the first reversal up will be minor. So in other words, probably sellers above the prior bar. And so we triggered that buy by gapping up above Friday's high, but rejected it. It does not look like there were buyers above Friday's high. Instead, it looks like there were sellers above. And this is also typical, so I'll draw this again. A lot of times when you have a contracting triangle, you get a breakout and then a retest of the apex of the triangle. So here we're getting higher lows, lower highs. we get a bear breakout of the triangle, only to pull back and test near the apex, the middle of the triangle. But this bear breakout, 24 through 27, traps traders. It may have been the second leg down, 1, pull back, 2, but it's enough of a breakout to at least reset the market cycle to some degree. By that I mean there are trapped traders. Bulls bought 23, they bought anywhere up here, they bought below 23. They bought anywhere within the triangle, betting on the bull breakout. They're trapped into a losing position. So the bulls have an incentive to get out of longs if given the chance at break even. So what happens? Well, another two-legged move. Two-legged moves are really common in trading ranges. That's what we have here. So 28, 29, bull, breakout, and follow through, pull back, and we ended up getting a spike and channel. It's really minor, but spike, pull back, and channel up to bar 35. And the problem for the bulls is the market cycle and the context. We're testing an area where traders were trapped. We're testing the breakout point 23 low, and the market cycle. Channels evolve into trading ranges. So this bull channel is more likely going to go back down to the bar 31 low before it rallies for a measured move up. And the context to the left supports this spike and channel, but still within a stronger bear breakout. So bears looking for a double top and a second leg down. Bulls just using this rally to exit losing long positions. Bulls trapped at losing positions on the breakout down to 27. Bears, they're trapped out of a winning position. This creates resistance above the market. Both bulls and bears looking to sell. So we test the area of agreement once again, and then everybody sells. Probably a give up bar on 41, bulls looking to buy lower, and bears becoming aggressive. And then this breakout down to 45 fairly clearly resets the leg count. Strong enough breakout, certainly trapped traders, and second leg down likely. Now is bar 50, the sell-off from 47 to 50, is that the bears' second leg? 1, pull back, 2. Oftentimes you get that brief second leg, but there's hardly a trend line break here. And more often than not, that brief second leg that you get is actually part of the first leg. It's all part of the same leg. If you look at a higher time frame, again like the 15-minute chart, there was no pullback here. So this is a simple leg, and it's a fairly strong breakout. So when you put that with markets like symmetry, the bears are probably going to get a breakout more symmetrical than this. The second leg is too small here. But this pullback does shift the market cycle from spike to channel. And we know that channels evolve into trading ranges. So traders start to buy at new lows, and we have test targets, the bar 47 high. Why the bar 47 high? Big bear breakout, weak reversal attempt, but it is a reversal attempt, and you'll have some bears who buy back shorts above 46. So bears exit here. You'll have some aggressive bulls taking a chance. They'll buy here, and the bears and bulls who bought here are trapped. Bears trapped out of a winning position, bulls trapped into a losing position. Both the bulls and the bears want higher prices so they can sell. The bulls will scale in and they want to sell out of their longs at higher prices. The bears want to pull back so they can enter short and capture a second leg down. Now what happened down here is really similar to what happened over here. 52, leg 1, pullback, leg 2 up to 55, leg 1, leg 2, but tight enough that this entire rally may be one simple leg. And that means we may need a second leg up of this entire rally. So instead of trend resumption for the bears here, this might just be a pullback of the pullback. So here down to 58 is similar to here down to 18. The bulls might need one more leg up before bulls and bears sell. The bulls give up and the bears become aggressive. We finally test, I don't know if we quite got there on 55, but we finally tested the 47 high on 63. And think about 63. First close, or first time the bulls finally get a bar above the moving average. But what's the context? Big sell-off, still no second leg down yet. Is this a major reversal? Well, that's what the bulls are hoping for, and major trend reversals are generally low probability, 40%. So the bull argument here is yes, this could be a major trend reversal. Bear trend, trend line break, retest of the lows, and we tested a breakout point, 50 high, and then a higher low, major trend reversal, maybe buy above 60, 61. That's what the bulls are hoping for. But for me, and it depends on what you've studied and what your research shows, but I truly believe the vast majority of the time breakouts get some sort of second leg better than this, and when they don't, that's what leads to big rallies, is trapped traders like that. But here, the rally couldn't even get a bar completely above the moving average here. And again, I'm not sure if this was bears attempting to resume the trend as much as it is bulls who bought here scalping out and a pullback of the pullback, like I said. And so look at bar 63. Possible double top with 55, leg 1, leg 2, subdivided into two legs here, 61, deep pullback, and then up to 63. So bar 63 is one of those situations where the bulls really need one more bar. The bulls are going for the low probability event. They want the major trend reversal. They want the breakout of what is either a trading range or a bear flag because of the context, the bear breakout to the left. The bulls really need follow through here. They really need 63 to close above 55, all the bars here to the left. And instead, when they needed one more bar, everybody bailed out of the trade. So bulls using this rally to exit longs. Remember all the traders trapped up here. Let me see if we can find what's some sort of potentially reasonable trade for the bulls. And I wouldn't recommend doing this, but maybe you buy below bar 7, the bottom of this range. Buying on a limit order here is like catching a falling knife. You really need more reasons than it's the bottom of the trading range, especially when the approach is like this. If the approach is like choppy, like breakout, pause, breakout, pause, breakout, that's another thing, but this is more sustained selling. And so the point is, if a bull bought here, scaled in, they certainly could have avoided a loss by exiting at their average price. But you can see what happened on 63. We came close to testing that breakout point, the bar 7 low. We didn't quite get there, and then everybody bailed out, and we got that strong second leg down. Now, the one thing about this sell-off at the end of the day, one thing that always comes to me when I think about trending behavior toward the end of the day is what Al talks about with profit taking. At the end of the day, the institutions need to take profits. So you have institutions that were selling all day long. They get this windfall of profits toward the end of the day, 10 bars left in the day, and whether it's the risk manager, the traditional stop is up here. If you're selling, 1 times your risk is all the way down here. You need to start reducing your position, or at least offloading the risk. An easy way to do that is to reduce your position size. In other words, take profits on your shorts. So if bearish institutions start buying to buy back shorts, price has to go higher to find sellers. We're also testing Friday's low. And the odds were there would be buyers below that bar. Again, using the daily chart to see that. Good looking buy signal bar, but instead of buying above the bar, traders will buy below the bar. Stop order traders not making money, but limit order traders probably going to make money as we get more two-sided here and maybe start to channel. So we break below Friday's low, retest it, get a second leg, but then we get that, this is one of those bars. You just get out above 76 if you're short and look to sell below a bear bar, closing near its low, and you just don't get it. But it's a default safety exit to just get out here, because bar 76 needs a second leg. It's probably going to get a second leg. And even though you can stay short with the stop up here, if you think the market's going higher, it doesn't make sense to hold short. It makes sense to exit shorts and to sell higher if you think price is going higher. So to me, I think this is profit taking into the close of the day. And the bulls got a good enough rally here that they'll probably get a second leg, but the context, big down, big up, big confusion, both sides likely to get second legs. The bears probably will get a second leg down. The bulls will see that as a pullback, look to buy down here, maybe the 75 high, then rally. But that, of course, can create a contracting triangle again. Big down, big up leads to sideways price action. So that's going to be it for today's recap. Thanks everybody for watching, and I hope everyone has a good night.